Rain-time market charts ripple across a dark screen. The quiet humming of an apartment tower at dusk fills the room, while market numbers flicker in a continuous digital auction. It is natural to look at those flickering prices and believe that enough research will unlock a hidden signal that everyone else missed. Our minds are trained in almost every human domain to believe that relentless effort leads directly to superior performance. When you study harder for an academic examination or train longer on an athletic track, your results improve in direct proportion to your active effort. Yet in the architecture of global capital markets, hyperactive effort is often the precise mechanism that destroys personal wealth. What if the true edge in building lasting financial security is not selecting corporate winners, but systematically owning the entire productive engine of modern commerce? When you purchase an individual stock, you are making a specific claim about your ability to forecast the future cash flows of one company against all others. You are betting that your personal evaluation of earnings reports, management capability, and industry trends is superior to the pricing consensus of millions of global participants. Every single day, multi-dollar financial institutions, high-month window, roughly 60 to 70% of professional active equity managers fail to outperform a simple broad market index fund like the S&P 500. When you extend that evaluation time frame out to 10 years, the failure rate among professional active fund managers rises above 80%. Across a 20-term wealth strategy, if professional institution managers with terminal infrastructure, private research desks, and billions in institutional capital cannot reliably beat the index over decades, individual stock selection carries a steep statistical penalty. The structural reason active stock picking fails so consistently lies in how equity market returns are mathematically distributed across individual companies. Most investors operate under an intuitive assumption that corporate stock returns follow a standard symmetric bell curve distribution. They assume that half of all available stocks will perform better than the market average, while the other half perform worse than average, creating a balanced risk profile. Rigorous academic finance research has definitively proven that stock market returns do not follow a normal bell curve at all. Instead, stock returns display extreme positive skewness, meaning a tiny minority of public companies generate virtually all aggregate market gains over time. Professor Hendrik Besembender of Arizona State University conducted a landmark study analyzing over 26 to recent years. His research uncovered a fundamental structural reality that alters how we evaluate corporate stock selection. The study revealed that the majority of individual common public stocks fail to outpace the performance of short-free treasury bills over nearly a century. The remaining 90-term cash yields or suffered complete long-performing winners that drive total asset expansion. You do not need to identify the next generational corporate giant before it emerges because the market index automatically increases its weighting as the business grows. Designing an index investment system requires translating these statistical realities into a clean, automated operational framework. A properly constructed index allocation prioritizes ultra-market index vehicles. Rather than purchasing multiple specialized sector funds or narrow thematic ETFs, a complete equity foundation can be built using just one or two broad index funds. A total stock market index fund provides immediate fractional ownership in thousands of large, mid-5% of your total accumulated capital over a full investment career. By capturing full market returns while eliminating unnecessary management fees, your balance sheet retains maximum compound velocity. The third step in system architecture is establishing fully automated contribution channels. Relying on manual monthly transfers requires continuous personal discipline and invites destructive emotional interference during market volatility. When news headlines turn pessimistic, manual investors often delay or halt their routine monthly investments out of emotional fear. Automating your monthly contributions ensures that you acquire more index shares when valuations drop and fewer shares when prices rise. This systematic purchase The fourth step involves placing your broad index holdings inside tax-advantaged vehicles like retirement accounts, protect dividend income and realized capital gains from immediate annual taxation. Protecting your compounding returns from annual tax drag enables your dividends to reinvest at full velocity over multi-advantaged contribution limits are fully utilized each year. Excess capital can flow smoothly into a standard taxable brokerage account. Because index funds have extremely low internal asset turnover, they generate significantly fewer taxable capital gains distributions compared to active funds. The fifth step is implementing a strict mechanical rebalancing protocol to maintain your target asset allocation over time. As different asset classes grow at varying rates, your actual portfolio balance will gradually drift away from your original strategic allocation targets. Instead of adjusting your portfolio based on economic predictions or market commentary, establish an objective time-based rebalancing trigger, a calendar-selected date. If asset weightings have drifted beyond your target allocation ranges, you gently trim overweighted asset classes and allocate capital into underweighted ones. This systematic rebalancing process forces you to sell high and buy low. Without attempting to forecast, short-term investment success is rarely market. During cyclical market downturns, financial news outlets amplify panic, causing short cleansing, underperforming. Obsolete companies gradually decline in market value and are naturally reduced or removed from the index entirely. Emerging highly profitable companies automatically expand in market capitalization and occupy a progressively larger share of the index weight. This continuous self-picking strategies. It rewards patience, minimal structural fees, and the quiet discipline to allow compounding to work uninterrupted over multi-decade horizons. By replacing active stock selection with broad market index automation, you eliminate structural friction and capture the full earnings power of the global economy. Building long-term prediction. It is about building simple, durable systems that survive every market environment.